Steel producers have been making a lot of money over the last few years, and being a stockholder of a steel company has been quite equitable. They pay high dividends and their stocks have been going up. In this video, I'm going to cover Ternium. This is a steel producer. Most of their operations are down in Mexico, strategically located just south of the United States. My name is Victor, and I am an active value investor. I have an MBA, and I do a lot of analysis in the companies that I invest in. I like sharing that analysis on YouTube, and let me tell you more about Ternium. I like to follow a process in my investments, and it covers 4 key questions followed by a decision whether I want to buy, hold, or sell this stock. First, do I understand this company? Do I want to be an owner of this company? Do I understand the industry, and do I want to be a part of this industry? Second, do I believe the management team is operating the company well? Is the balance sheet in good health, less than 3 times EBITDA? Am I getting a discount on the stock? Super important. I'm investing to make money. And if I get a discount, I expect that stock's going to rise and it's going to reward me with a good return. Based on the answers to those questions, I either buy, hold, or sell. The story on this company is they produce sheet steel that goes into cars, appliances, and other products that require steel to manufacture. Being strategically located down in Mexico for most of their operations gives this company a big advantage because their biggest market is the United States. As you may be following, car companies are located down in Mexico. Tesla just announced they're going to have a gigafactory open up down in Monterrey, which is where this company is located. So there is a lot of demand for this product that the company produces. The industry. Now, the industry is quite simple. You know, they take iron ore and they produce sheet steel. It takes a lot of labor, takes a lot of capital to create these factories and these operations. Now, they are subject to commodity prices. If commodities prices go up, these guys make a lot of money. If commodity prices go down, significantly down, then these guys suffer, losses. This company over the last 5 years, they've had ups and downs in commodities. But right now, the commodity prices are quite fair. Let's take a look at their income statement. And first off, looking at their 5 years history of earnings, they have grown their revenues from 11.4 billion up to 16.4 billion. It's really nice to see that, over 4 years, it increased their revenues by 43%. And that's a lot of volume increases as well as, fair pricing as well. Looking at their most current quarter, their revenue did drop compared to the previous quarter, and that is unfortunate. It is a drop of 15% quarter over quarter. It's mainly due to pricing. It's not a volume thing. It's not a operating thing. It's just a commodity pricing decrease. Overall, they were profitable. Great to see that the company is profitable, even though their top line was lower. Looking at earnings per share, first, they've been surprising to the upside, which is good to see. Their most recent quarter surprised to the upside. Good job. Second, their expected EPS for the year is $6.91 per share. That's based on 11 analysts covering it. And then next year, they're expecting the earnings per share to be 6.13. Again, commodity prices will change that. So you got to track companies like these quite closely, track where commodities are going and so forth. The PE ratio is super low, 6.3. I mean, that is super low. If commodity prices are fair, these companies just make a lot of money and they pay a really high dividend. So I really like that. I really like that low PE. Look at their balance sheet. They have a pretty fair amount of cash, 1.2 billion, and they have less than that amount in overall debt. So that's good to see. Their EBITDA is a good amount, and their debt is so low that they're below the 3 times EBITDA for debt, which is a good sign that the balance sheet's in good health. Looking at the statement of cash flows, this is a cash producing business. They had $612 million of cash flow from operations. They did have some CapEx of $197 million. So it gave them a free cash flow of $414 million. Now, that was lower by 27% compared to the first quarter of 2022, principally because their top line on their income statement went down It's just a pricing of commodity thing, but it's really good to see that this company has positive cash flow. I value companies using the free cash flows that I expect they're going to produce and discounting those free cash flows to today's dollars. And I also look at earnings per share. Let's take a look at free cash flows first. Now, if we look at 2022, I'm going to take their free cash flow that they produced in that full year, and I'm only going to take 67% of it. As noted, it had gone down about 27%. So I'm going to go an additional 5 points and take it down to 67%. So it brings it down $1.4 billion of free cash flow. I'm not going to grow that cash flow very much in the first 4 years, but then I'm going to start growing it at 2% into the future. I think that's fair. I think there'll be some upside years because commodity prices are going to increase as we get out of this recession and pricing will be more favorable. But this is a conservative approach to looking at what cash flows are going to come in the future. We have a terminal value, meaning all cash flows beyond year 4 are expected to be about 16 billion. That's discounted to today's value of which equates to $14.5 billion of value if we look at those cash flows. Adding on the cash on the balance sheet and taking away the debt, it brings us to an equity value of $14.8 billion. The current market cap is only $8.6 billion. There's 196 million shares outstanding. So I get a value per share of almost $74, but the stock price is trading at 46.79. So using the cash flow method, there's about a 58% discount on the stock. That's really nice and attractive. But let's look at earnings per share. So using the analyst expectations was 6.91. And I'm going to use a PE of 10. Again, their historic PE has been about 6.5, but that is just way too low. I'm thinking this company is worth at least 10 PE. And using those factors with a 2% growth rate, we get an earnings per share value of $59.62. Looking at the current stock price, you have about a 27% discount using the earnings per share value. I like weighing this number more than the earnings per share. I go 2/3 value or weight of the cash flow method and 1/3 weight of the earnings per share. And I get a discount of 48% available on Ternium, which is a nice discount. The stock price for Ternium has really gone up in 2023. It's gone up 46%, and it pays more than a 6% dividend. The performance of the stock year to date has been excellent. And again, they pay a nice dividend of 6%. So you benefit two ways from this stock. Profits were good. Revenues were down due to commodity pricing. Cash flows were positive, which is great to see, although they've been decreasing. As commodity prices rise, you'll see those cash flows increase. For 2023, I believe, commodities are going to go up as we begin to see that demand for new cars and so forth go up. Commodity prices will rise, and the company would become more profitable. In fact, I think it's going to be quite profitable in Q4. Higher free cash flows, and the dividend will continue. In fact, it may even rise, especially if they've had increases in the dividend rate, and that could happen again. I like the geographic advantage of most of their operations being in Monterrey, Mexico. That's just south of Texas, so that car manufacturers, appliance manufacturers, and other product manufacturers can manufacture down in Mexico where there's a less expensive labor force. It's strategically located, so you don't have to deal with supply chains over the Pacific Ocean or the Atlantic Ocean, and then distribute your product into the United States. In fact, Mexico took over the #1 spot as the #1 trading partner for the U.S. It took it over from China just recently. The growth in the region is there. Tesla announced they're going to have a gigafactory in Monterrey, so they're going to need steel for their cars. So there's another customer for this company, and I really like their high dividend and really good appreciation. All right, so let me scorecard Ternium. First, do I understand the company? Do I want to be a part owner in this company? Do I just understand the industry? Do I want to be part of the industry? Absolutely. So I really like the company. I like their location. I think they have a lot of advantages that other steel producers don't have. I think it's operated really well. Their management team's doing a really good job. And I like the industry. I know there's some ups and downs that commodity prices could really spoil years, so to speak, because commodities could be really low. But when commodity prices are higher, these companies are really profitable. And I'm okay with maybe having a year where a company loses money, but in 4 years, they just make a lot of money. I mean, hey, I'm all for the average of this company being super good. I want to be an owner of that type of business. As mentioned, I think their management team's doing a great job. And their debt is really, really good because it's less than 3 times EBITDA, and they have more cash on the balance sheet than they do debt. Really nice discount available on the stock. So I am buying more shares of Ternium. Hey, thank you for watching the video. I really appreciate it. Do me a favor and leave comments on the video. I really appreciate everybody who's been commenting on the videos. The intent is to really put information out there that helps investors and learn and really get to know these companies that I've invested in. And I've benefited greatly from other YouTubers. It's probably the place over the last 5 years that I've gotten the best knowledge and really have become a better investor, is by watching other investors that are actively doing their investing, analyzing companies and so forth. So please keep the comments coming. Keep in mind that what I do is for entertainment purposes only. I don't recommend Ternium as a buy or a sell. It's just, I want you to consider this information as educational entertainment. And this is not financial advice. Good luck investing in 2023.